9 a.m. in Shanghai, Shenzhen, and here in Hong Kong, you're watching The China Show. I'm Yvonne Man with David Ingles.
Good morning. We are counting down to the open of markets in Greater China. Our top stories today, the dollar at its lowest in almost 4 years. Stocks rising ahead also of the Fed decision. President Trump says he is not concerned about the currency slide.
No, I want it to be just seek its own level, which is the fair thing to do. You could have it, I could have it go up or go down like a yo-yo.
UK Prime Minister Kier Starmer arrives in Beijing with a business delegation later today on a mission to broaden trade ties without antagonizing Washington.
Also ahead, India and the EU seal a deal after decades of discussion, creating a free trade zone of 2 billion people.
And I'm Stephen Engel at day 2 of the Goldman Sachs Global Macro Conference here in Hong Kong. Stay tuned for key conversations on the path ahead for the Fed and also the outlook for commodities demand in China.
Good midweek session to all of you. We're looking at, again, some period of stability right now at much lower levels. Of course, there's the caveat there when you look at the dollar index, and certainly 120, we're back there on the euro, on the Bloomberg dollar index. We talked about this near a 4-year low. When you look at the DXY, for example, any signs that this is getting overheated or oversold, specifically 5-year low on the 14-day RSI. Yes, strongest level in the Japanese currency. Going back, flip the page, please, going back to October. So certainly conversations, not just on the Japanese side, but on the U.S. side, really leading to where we are right now. And certainly it's going to bring up conversations around what the fix and the significance of today's fix is going to look like coming out of the PBOC. We'll get to a statistic in a moment for you, which is going to put in that interesting terms here. Asia FX Index, our specific gauge here, coming up on your screens very shortly, the live price. 4 days of gains as far as that's concerned. Right. Now, the sort of commodity iteration of the weaker dollar has been the debasement trade, whether that's gold and silver. And we're also looking at Brent prices coming up on your screens. That's also, in case you missed it, and most people probably did, Brent prices are back to the highs since October here. Goldman's out with an upgrade on prices of aluminum, although the price projection is slightly lower than current levels right now. More on that in a moment. Let's have a look at the equity markets as we approach the open. So 2 things, right? One is everything except the Japanese equity market, which tends to, of course, move inversely to the movement or the value of the currency right now. That's playing out quite clearly. Specifically, when you look at the exporters like car makers, machinery, consumer electronics, all feeling the pinch right now. Kospi's going the opposite way. Taiwan is coming online. A50 futures are coming up on your screens. We talked about crude. Shanghai crude is going to be third. And, of course, dollar China. And the spread between this and the onshore rate is actually not the widest in several months, right? So the PBOC has an opportunity, if, of course, that's where we go with the fix. If that's on the weaker side of things, that gap slides and narrows back, but we'll see, of course. We'll find out in about 12 minutes from now. But yes, lots of conversations to have, Yvonne, going into the markets open, of course, today.
Yeah, I think, you can't go wrong with talking about the historic moves that we've seen with the dollar, right? Yeah. I mean, you're talking about, a 3 standard deviation move, nearly, when it comes to what we saw overnight, that 1% drop in the Bloomberg dollar index. And really, it's going to only add to this whole debasement trade as we've been seeing it play out. And also really reinforce some of the policy, or at least the FX moves that we've already seen, right? Fresh momentum for the yen bulls out there and more appreciation pressure for the renminbi now, too.
Yeah, and I wonder it's coming at a time when in less than 24 hours, right, we have the Fed meeting that's going to come up, and whether or not that will feature in the statement itself. What traders are also doing, I think, interesting, too, is even before the comments out of Donald Trump came out, which furthered and opened up that further leg of downside, the pricing around, let's call it the cost to short the currency, it's a simple way of putting it, is actually not a record high. So people are still piling into it despite it being a very expensive trade at the moment. So expectations are still rather one way on the dollar, that one way is down.
Yeah, Stephen Jen from Horizon just came out with a note saying, he doesn't believe there's sufficient market attention yet to the recent movements in the dollar, right? Is this sort of the start of some multi-year structural dollar correction that's going to be out of sync with what you're seeing with stocks? We did hit near records, or at least close to records in the U.S. stocks overnight here, as well as resilient economic growth in the U.S. So certainly that's a lot of questions and what's really going to be driving the dollar from here on forward, right? Because it's not rate differentials. It hasn't been like that for some time now. It continues to be the policy risks and uncertainty around some of the policies that come through from the Trump administration as well. So it was some of these comments that kind of rocked the market. Let's take a listen.
No, I think it's great. I mean, the value of the dollar. Look at the business we're doing. No, I want it to be just seek its own level, which is the fair thing to do. You could have it. I could have it go up or go down like a yo-yo.
David Finnerty is with us, our FX and rate strategist. He joins us to talk us through what is going on in his head as we look at those comments and really this massive move down in the dollar, David. Where's the floor in this?
Well, I'll tell you that when London comes in, I think what's interesting, London really doesn't have which is a huge FX centre, hasn't had a lot of chance to react to Trump's comments. So I think while at the moment you're seeing the dollar sort of steady in Asia, I think let's see what happens when Europe gets in and what they want to do with it. You'd have to think they want to sell the dollar. What was interesting yesterday, I was talking to some London traders prior to Trump's comments, and they were saying that they're seeing a lot more widespread interest in selling the dollar versus the euro and obviously Aussie dollar and other currencies. So everyone talks about obviously the yen. Dollar yen was like the initiator, shall we say. That started to broaden ahead of Trump's comments, and you saw the euro break through 119, was previous resistance against the dollar. That adds momentum to that. So you get this idea of hedge funds and investors becoming a lot more widespread in terms of what they wanted to trade against the dollar. So when your London kicks in, you'd have to think, well, let's continue that same theme logically. So I wouldn't be surprised at all if there's a lot more selling dollar, broad dollar selling, with main beneficiaries being the yen, the euro. There's a lot of digital buying in options overnight in 3 to 6 month tenors for the euro and the yen. So there's a lot of interest in there from hedge funds. But Aussie's always popular because the RBA may hike. Kiwi's popular as well. And even sterling, but to a lesser degree. But pretty much it's coming across the board now that it's just pretty much sell dollar against anything is becoming more and more the market sentiment.
Yeah, and I guess part of that list you didn't mention is the renminbi, right? Because it's almost given more fuel for this trade for dollar China to head lower. I'm just wondering, what should we expect in terms of the PBOC? Do you think that they're going to push back quite a bit on really kind of slowing this appreciation?
It's going to be interesting because when the PBOC come in, the dollar appreciation is one thing. We know it tends to like a slow grind. The catch is you've also got to remember actually the euro versus CNH. That is also, the euro has a big weighting, second biggest weighting after the dollar in the CFET's basket. So PBOC was certainly aware what euro CNH is trading. And obviously the euro had a very strong day yesterday. So that's going back up towards, euro CNH is going back up towards its 2025 highs, and PBOC needs to be aware of that. So he won't want it to blow through those highs. So it's going to have to factor that into its equation. So it's got a very interesting bit of dilemma here. It's like, well, the dollar's weakening, I've got to watch that, but I've also got to watch what I'm doing against the euro as well. So I think a lot of people will be watching this fix today to see, what speed it wants to go. Generally, we know the PBOC likes the slow grind, appreciation or depreciation. But obviously, in this case, it tends to be more, the yuan is tending to appreciate more.
David, thank you, David Finnerty there, joining us with the latest on all things dollar. And coming up, we'll speak exclusively to Goldman Sachs' Vice Chairman, Rob Kaplan, about his outlook for the U.S. economy. Of course, given his former credentials in the Fed as well, Fed policy and the dollar that's coming out at the bank's annual global macro conference here in Hong Kong. We're counting down the trade of Shanghai, Shenzhen, and Hong Kong here. Of course, it is really about volatility that we're seeing in FX markets here today, but futures at least are pointing higher in China, up 0.4%. This is The China Show.
it's time to take a breath on these rate cuts. They've made a number of cuts that are still feeding through the economy. And so I think it makes sense in the face of elevated inflation and what seems to be coming this year, that it would be a good time to pause and really take stock of how they assess the economy on both sides of their mandate.
Former Kansas City Fed President Esther George there speaking to us earlier. Time to head back and really continue on this Fed conversation and go to the Goldman Sachs Global Macro Conference in Hong Kong, day 2. And our very own Stephen Ingle is standing by with our next guest. Steve.
Thanks a lot, Yvonne. Robert Kaplan is our next guest, Goldman Sachs Vice Chairman, also the former Dallas Fed President. Very timely again to have you on board here on the China Show. We're going to talk about the FOMC and what Jay Powell and company should or might do or will do. But let's talk about the dollar. That's the top headline right now. Obviously, a further depreciation overnight. Donald Trump adding a little bit accelerant to that, essentially saying he's not too worried about a weaker dollar. What do you think is the true reason and manifestation of this weaker dollar trend, and how long will that last?
I think around the world, I think investors, pools of money are taking a fresh look at the U.S. There have been a number of events over the last couple of weeks, domestic and geopolitical. And I think what you're seeing, you'll notice gold is up, alternative currencies are up. I think there's a little bit of a reposition here. You'll notice stocks in the U.S. are not down. So people are sticking with their risk positions, but I think are probably buying some tail risk protection, hedging the dollar. I think we saw that in the first half of 2025 also. I think it will run its course. It puts an onus on calming down some of the tail risk, and I think that would help this.
I mean, it is to say that it's to help boost exports, too simplified explanation for what we're seeing here.
Yeah, I think, yes, it is true a weaker dollar boosts exports. However, we have, in the United States, has 39 trillion of debt on its way to 40 trillion plus. And when you have that much debt, I think stability of the currency probably trumps exports. And so I actually think the U.S. is going to want to see a stable dollar and wants to see stability. And they want to be able to sell the long end of the Treasury curve. Stable dollar helps.
I mean, there are concerns, obviously, and there is a lot of noise about it, that this could be the beginning of a multi-year structural correction for the dollar. You don't see that?
I don't know that that's the case, no. I think there's a lot of strengths in the United States in terms of innovation. Very strong year for GDP growth coming, we believe, and a lot of positives. However, people around the world are not, I don't think they're running away from the U.S., but they're managing some of the tail risk and the institutional framework. They're trying to make sure they understand it, and on the margin are taking action to probably hedge the dollar or buy some alternative safe havens. Gold is the most prominent example.
Absolutely. So gold obviously has seen the upside. Do you think 6,000 an ounce is a target? I know you're not the prognosticator of currency or commodity markets, but...
Well, the house view is we could see gold getting into 54, 5,500. I don't think that's an unreasonable view. It's had quite a run here. You may see some retrenchment, but we think stronger gold makes sense.
How do you read what's happening in Japan? Obviously, the yen is a beneficiary of the weaker dollar. It's at 152 and change right now. So there was a lot of chatter about intervention when it approached 160. Yeah. There's, fiscal challenges, obviously, and fiscal stimulus being proposed by the prime minister, but there's been a bond market rout and a lot of turmoil. How do you see this dovetailing with what's happening with the dollar?
So here's the dilemma for Japan, and this is true of a lot of the developed world. Aging population, in Japan's case, shrinking workforce growth because of aging, and very high leverage. And so there isn't at this stage as much capacity or market willingness to go along with more fiscal stimulus. On the other hand, there's things that the central bank would normally do to protect the currency, i.e. raise rates. And I think talking about excess fiscal has sort of had an effect in the market. So I think you'll see that calm, and it will probably need a combination of some fiscal action and probably the central bank taking some action to protect the currency But I think in between now and the election, I think they just want to calm this. But ultimately, it's a symptom of these structural issues, aging and leverage. This is why productivity growth, with AI being one of the catalysts, is the big upside for many developed countries, including the world. And a lot of the world will be watching how fast you develop AI to improve productivity growth.
How do you read the reports and the speculation that the New York Fed did a rate check at the behest, perhaps, of Treasury to sort of send a signal to the market that there could be coordinated intervention?
So obviously, I've seen the same reports. I think it's in the U.S.'s interest that you don't see the back end of the Japanese bond curve move up, because it will affect the back end of the U.S. Treasury curve. And so I think some rhetorical intervention, at least, doesn't surprise me, because I think it's in all of our interest to see stability. In the kind of environment I talked about, aging and leverage, we're seeing duration challenges around the world, and I think we want to calm that.
Is there a risk, last question on Japan, is there a risk that Japan could start selling off some of its $1.2 trillion in treasuries as a bit of a backstop, as a bit of a way to calm the bond or currency markets? What would that impact be?
I think the bigger issue that Japan, I think, will have to wrestle with is the fundamentals. Lack of workforce growth, maybe bigger guest worker program. They'll probably talk about faster productivity growth initiatives, AI being part of it. I think you've got to get to the fundamentals, which is a little bit of better growth in an aging society with all the government debt. These other things are more on the edges. You probably have to address the fundamentals.
And calm messaging from authorities.
I think so,
yeah,
yes.
Absolutely. Let's talk about the FOMC. We're going to get the decision early morning Hong Kong time tomorrow. Widely believe, as Esther George, we just heard, saying it's time to pause. You agree? Yeah,
I do agree. I think the Fed right now is at neutral. What do I mean neutral? We're at 3.5, 3.75. The neutral rate is, I think, 0.75 to 1% real, and then add the inflation rate, 2.75. With inflation still running at 2.75 and expectations of stronger GDP growth, i.e., which may help the job market, I don't think they want to move until they see demonstrable evidence that inflation is improving. If they see that this year, they'll move, but they don't want to act until they see it.
Is there disunity, though, among Fed participants? That was the concern. I talked to Patrick Harker, the former Philadelphia Fed president, who essentially said this causes problems. He was quite surprised in the last rate decision in December by that disunity.
I think there's debate and disagreement, and I think that's a good thing. And here's why. When we were at 4.25, 4.25, 4.5, it was easier to go along with cuts to buy labor insurance because we were still the Fed was still restrictive. The reason the tensions got higher is once you're getting to neutral, I think a good part of the group said, I don't want to be at neutral with inflation sticky and, by the way, above target for the last 4 or 5 years. I think you'll see now that they bought the insurance, I think you'll see a pretty good consensus among the group. We don't want to act until we see improvement.
And your views again on Fed independence? Obviously, there's been lots of ramping up of rhetoric coming, whether it's from the DOJ and having the subpoena. Jay Powell stood strong. Of course, he's going to be handing off his position. He could stay on as governor, though. How do you think this plays out?
So let's take it in pieces. In December, a lot of people may not have paid attention to this. The governors voted unanimously to extend the term of all the bank presidents, other than Raphael Bostic, who's retiring. That might have surprised people. Unanimous vote, by the way. Okay, so I think there's more likelihood there'll be stability among the presidents. Then, if the Supreme Court does not allow action on Lisa Cook, you've got 4 seats with Jay Powell's the one that's up for grabs. I think he's likely, I would have thought, not to stay on. And so there'll be 4 seats with the new chair. It means the new chair will push regulatory reform, may have more collaboration with the Treasury on the balance sheet, but on the Fed funds rate, he's not going to have 7 votes wired. He's going to have to persuade, debate, disagree. I think that's a good thing. He'll argue that the Fed should anticipate inflation improvement. The committee will want to see it, and that'll be the debate.
All right. Robert Kaplan, thanks so much.
All right,
we could
good
go
to see
on
you,
and
Stephen.
on. I really appreciate it. Very timely. Of course, as we continue day 2 coverage of the Goldman Sachs Global Macro Conference here in Hong Kong. Back to you guys.
Extremely timely conversation ahead, of course, of the Fed decision. Given the dollar moves, really, it's almost like we are blessed by the news gods today, given the voices coming through. Lots more coming through as well out of the macro conference there with Steve later on. So stay tuned for that. The bank's outlook, metals prices, we mentioned Goldman and their move on aluminum and why they think demand destruction in China could actually trigger a correction. The fix of the day.
Yeah, if you didn't, missed it just now, we're just going to recap it real quick. So this was the strongest fix set by the PBOC since August. So they're not quite too concerned about the recent appreciation of the currency here. Not fighting back too much here this morning. We're talking about dollar China now at 6.93 against the dollar. Plenty more ahead. This is Bloomberg.
Welcome back. You're watching the China Show. Risk rally continues here in the Asia Pacific. Ex-Japan, the weaker dollar is weighing on the Japanese equity side because of the strong yen. The tailwinds are coming through in the form of many things here in Hong Kong. A weaker dollar. You have this IPO, this debut today. Busy Ming, Hong Kong. I think you have 2 more on the mainland today. Set to open much, much higher. And amongst those things, of course, this risk rally continues, right? We're trading at about 4+ year highs on the Hang Seng Index.
Yeah, 4.5 when it comes to the Hang Seng. So certainly, the equity story still remains quite intact despite the volatility that you're seeing across FX here globally this morning. When you talk about the historic moves that we've seen in the dollar against the yen, against the euro, and the like. Renminbi, right? We just had the strongest fix on the PBOC since August. So they're pushing back, but not too much when it comes to this fresh appreciation pressure on the renminbi here. So that's one thing to watch. We'll talk about the spread between onshore and offshore in just a moment. But there you go. Onshore equity is looking pretty strong right now. We're up CSI 300 by about 0.5%. Keep in mind, we're watching, of course, some of these kind of large cap names like the local chip makers, which have been kind of selling off of late, just given the whole NVIDIA H200 sort of story that we brought to you a few days ago. Also watching, of course, the CATL story as well. There was an interesting note coming through from analysts talking about maybe some of the margin pressures from the company, the battery makers and the like. Of the boards and see how Hong Kong is doing. It looks like Shanghai crude, they mentioned, the move that we saw in crude prices seems to be catching up as well. We're up about 2% for futures in Shanghai. HS Tech is a bid here this morning, with the exception of Alibaba. There you go, though. It was just kind of a slow going there, but we are mostly higher. It's interesting. You're not seeing that pronounced moves in tech. Look at HSBC. We're trading at 137 now. We're up another 2% after the stock basically set a record yesterday. It's a massive milestone for a bank stock here. Record $300 billion market cap for HSBC now. So certainly, you're seeing the financials certainly catch quite a bit here. We'll talk about that, but that is one of the sectors to watch for sure. Because given what we've been seeing, whether it is the outlook for property and the like here is looking better in Hong Kong. Hang Seng property is up another day. We're up about 0.4%. So maybe some of the old traditional sectors in Hong Kong are actually outperforming the tech space here. Keep in mind also when it came to AIA, Morgan Stanley raising their price target by 16%, talking about strong growth for its value of new business for 2025. Yes, the debasement trade continues on here today. So we talked about gold and silver hitting records, just given what we've been seeing with the dollar story. You are seeing some of these gold miners like Zijing Mining extending those gains yesterday after announcing that takeover deal. But yes, China Silver Group seems to be out leading that pack here right now, 2.6% higher. And we talked about, of course, more debuts to tell you about here. It's not just Busy Ming. You have Shandong Nongda and Shenzhen CSL Vacuum. But there you go. Ooh. 2 of the 3 doing very well today, Dave.
That's a good enough batting average for me. Let's get more insights really on state of markets and what the top themes to track will be over the next couple of hours. We mentioned the weak dollar. We mentioned this Korea breakout just now, the Hong Kong breakout, Hang Seng Index, 4.5-year high. Len Ting Tu, our managing editor for Asia Equities, is joining us from Singapore right now. Good morning, Len Ting. So let's start off with the weak dollar. How are we observing that play out across the region this Wednesday morning?
Yeah, weak dollar definitely is the biggest market story of the day today. But for equities traders, really the focus continues to be on chips and AI because SK Hynix and Samsung are going to report earnings tomorrow, and we'll see how much of a memory chip shortage there will be. And even today, 2 Chinese memory chip makers just announced price hikes, and that's the first time we heard from Chinese chip makers. So that's really adding to the momentum of the chip rally or chip bullish story across Asia. And last night we saw Texas Instruments also reported a very robust set of earnings. So that's really something people are continuing to watch. Another subset of the AI trade, which is fiber optics, and that because of last night's $6 billion deal struck between Corning and Meta Platforms for Corning to supply fiber optic and cables to Meta's data centers. We're going to see a jump in those fiber optic companies as well. And we're already seeing a bunch of them jumping in Japan. And there's a lot of them traded in China as well. So that is another thing people are watching. One third thing is just national team activity. We saw a pretty intense few days of national team selling of onshore equities. And yesterday we saw a little bit of a slowdown in activity. But people are still very much on their tenterhooks to figure out what's the national team's next move.
That's true. I'm taking a look at the Kospi right now. This headline just crossed terminals. South Korea stock market cap reaches $3.25 trillion, landing here, and that's topping Germany's market here. It seems like this is a market that defies even some of the trade tensions here, right? They largely shrugged off some of the terror threats from President Trump yesterday. We have Samsung, we have SK Hynix reporting as well later this week. What's in store for Korea moving forward?
Yeah, I think that, again, because the memory chip shortage is still so huge globally, the momentum is really strong. And this is also just the beginning of the year. We are still in January. People are still looking to pile into, various hot sectors. The chip, again, I know it has rallied so much, but that is still a very cheap sector, relatively speaking, especially if you look at Korea, the likes of Hynix and Samsung. And also, in Korea, this market cap takeover of Germany's, which is the world's third largest economy. It does speak a lot to Korea's chip or tech advancement. And of course, that also speaks to Korea's sort of K-shaped economic development, right? Domestic consumption is still very low, but export, especially tech export, it remains very strong. And if you look at the kind of other market cap comparison, Alibaba and Tencent, they are still bigger in terms of combined market value, but they are rapidly being taken over by the combined market value of Samsung and SK Hynix. So we're closely monitoring the kind of crossover of that pair. I believe it should just take a day or two for that crossover to happen.
That's crazy.
Yes. All right. We have to watch the Samsung SK Hynix spread. That's the one thing to watch. And yeah, both of them reporting at the same time. That's going to be quite interesting for traders out there. Lanting, thank you. Lanting, too, they're managing editor for Asia Equities. Let's talk a little bit more about stocks here and bring in Yiping Liao, portfolio manager at Templeton Global Investments. She joins us from Singapore this morning. Thanks so much for joining us. Let's start on Korea, just given that this crazy sort of rally continues and doesn't seem like there's much that could really stop it at this moment. Some of your biggest holdings are some of these Korean names like Samsung, like SK Hynix. Where to next for this market? It seems like it just kind of continues to gain in momentum here.
So Korea comes off 2025 as the best performing equity market. And months to date, interestingly, we see that this continues. I think when we look into this year, there are two key themes that we're focused on. First, earnings delivery. And here we continue to like the semiconductor names, so Samsung Electronics and SK Hynix, because we think they not only have very high earnings visibility, but there is in fact scope for earnings upgrades given the extent of tightness we're seeing in the memory cycle at present. The second leg where we're also quite positive on is on the value up story, where we think that 2025 was a year when government set the tone in terms of value up, but 2026 is the year when corporates take the baton and implement those value up plans. and successful implementation of this can lead to strong share price performance.
Right. Yiping, David here, I have a two-part question. One is, you mentioned month to date. Are you not nervous given this chart pretty much looks vertical? That's one part. And that goes into the second question. How do you suspect you will manage your exposure to those two big names over the near term?
I think that when you look at Samsung and Hynix, yes, the stocks have performed very well, but we still think that there is more room left in terms of earnings revisions. So when we look at, for example, our internal forecasts, we had penciled in something like a 80 to 90% increase in the DRAM, conventional DRAM ASP for this year. But interestingly, when you look at most recent channel checks, it looks like it may even exceed this. So in fact, we think that this scope for price increases and the fact that the supply response doesn't come in until earliest mid-2027 still leaves some room for these stocks to run.
You mentioned in your notes about hedging the AI trade. What is the best way to kind of hedge it right now?
In terms of hedging the AI trade, I think the most prudent way to do this from an equities perspective is to have exposure to key onshore markets like A-shares or India, in which there are many domestically driven stories, but not just that, the funds flow into these markets are also largely domestically driven.
Okay, understood. So what is that takes me to India, which, correct me if I'm wrong, is you're probably more overweight in India than your peers. Is that a bet of is that a hedging? Is that a function of hedging, or is that down to something else, Yiping?
India is perhaps a more contrarian view that we're taking at this point. It's not just a hedge against AI. We think on a standalone basis, India is looking more attractive at this juncture after underperforming in 2025. Because when you look at earnings, we think that earnings are going to inflect into the second half of the year. Valuations, while always on the expensive side, are looking more reasonable. And we think the funds flow or funds positioning looks particularly interesting here because foreign investor participation in the market is at an all-time low. So we think that if we have some positive catalysts, say a US-India trade deal, or even a an India-EU trade deal, we think that this could be a catalyst for foreign flow entering the market. So we think the combination of the earnings, the positioning, as well as the valuations does make India look interesting at this juncture.
Some still say, this India story isn't quite going to play out, right? When you take a look at, it still has weak nominal GDP, for example. I think UBS just quoted, also talking about, valuations have come off slightly, but they're still looking quite stretched, actually. And there is kind of the lack of clear AI beneficiaries. Why so much conviction in India still, you think? And how do you counter some of those arguments?
I think that India is a good bottom-up stock pickers market. What we've seen over the last few years is that the breadth and the depth of the market has improved. It's a large economy, it's growing from a low base, and what this means is that we feel we are able to find these bottom-up stock picking stories where even if the overall environment looks tepid, these bottom-up stock picks are able to compound high sustainable growth at good returns on equity.
Yiping, the final question for you. So a lot of this is as of November, so that might have changed, right? So I'm looking at some of the your big exposures, right? So TSMC, Tencent, Alibaba, you mentioned the two Koreas there. I mean, those are, I think, arguably, too, because of exposure limit, it's a conundrum for you guys because how do you outperform a benchmark when these are, the weighting is much more than 10%. So my question is, where do we get, those are beta plays. Bottom-up stock picking, give us a few names. What's the alpha opportunity in this market given that beta's just punching through the roof?
In Taiwan, it is challenging to get active exposure to TSMC. So from a tech perspective here, we focus on a few buckets. We like growth from a low base, so we think some of the ASICs related plays look interesting. A name I would highlight is MediaTek. It was a laggard last year. We feel that the market underappreciates its ASICs potential. Another opportunity for alpha in the tech space is within product roadmap upgrades. So here, liquid cooling, power solutions look interesting. I think that in the China space, we like picks on the innovation side. So one of our big active positions would be a name like CATL, which we think is leading in terms of battery chemistry, world-class execution. So I think that there are quite a few opportunities for alpha in the region.
Yiping Liao, thank you so much. Portfolio manager at Templeton Global Investments, joining us this morning to talk us through what they're excited about. Right, coming up here on the China show, we talked about this briefly just now. So India and the EU seal a free trade deal. That's after almost 20 years of conversations and negotiations. We'll look at the winners and the losers next. This is Bloomberg.
We delivered the mother of all deals. We're creating a market of 2 billion people. And this is the tale of two giants. And by combining these strengths, we reduce strategic dependencies at a time when trade is increasingly weaponized.
Friends,
India has completed its biggest and most historic free trade agreement. This historic agreement will make it easier for our farmers and small businesses to reach the European markets.
That was the Prime Minister of India, of course, Narendra Modi, and European Commission President Ursula von der Leyen hailing this free trade agreement finally after almost two decades of negotiations. And the pact should be formally signed after some legal vetting, which could take around 6 more months. Okay, Balazs Pant is with us right now, our news desk senior editor, to talk us through the finer print of this deal. And we're finally here, I think, is a good starting point.
That's right. And we heard just the glowing terms that both sides used about this. Ursula von der Leyen doesn't usually sound this excited about a trade deal. She called it the mother of all deals. And so that just shows what it means for both sides, for both the EU and India. And it shows the new world we're living in, where everybody's looking for new alliances. Everybody's looking for ways to reduce dependencies, especially on the U.S. and China in times where some of those are uncertain. Don't forget, this comes on the back of an EU deal with Mercosur, the South American trade association. So it is a major deal for the EU. It opens up a vast market for both sides, and it has a chance to really rearrange both economies a bit.
It's not just the economic ties, also security, right? There was this new security partnership, and it seems like both sides are really growing closer on the defense front too.
Yeah, that's right. And both are looking for sort of ways to cement their place in this changing global environment. We heard a lot of talk in Davos last week about how it's a new era for the world, both in terms of the global economy and, as you said, for security as well. So everybody's looking for new partnerships, new alliances.
Balazs, thank you so much. Balazs Pant there, of course, with the latest here coming through out of India, both in the economic and, as Yvonne is pointing out, also some progress on defense. A glance at equity markets, and we'll talk about FX in a moment here. So about 18 minutes cash market session. We're looking at gains across Chinese cash markets. India futures, we're looking at that given developments we're seeing there. That should be coming up on your screens, if not already. And an update on the dollar. Big collapse overnight. We're coming off lows in the Asian session this Wednesday, and as our colleague was pointing out, it's going to be interesting when London comes online and how they react to this dollar move. Do we have anything coming up on our screens? We don't. Okay, there we go. Thank you so much. London is going to be in green for you. So we're going from Tokyo, London, New York. We're in Tokyo time now, and we'll see when London wakes up and how that looks like. Plenty more ahead.
Some stories that we're tracking for you this morning. Holders of 2 China yuan bonds have accepted the developer's plan to delay the bulk of those payments by a year. The notes were both originally due last month, but filings show all holders voted in favor of the revised extension plan. Wanke would now repay 40% of the principal on both bonds on January 28th and the remainder in December. LVMH ADRs closed lower after sales at its key fashion unit fell over the holiday season due to sluggish demand. Organic sales for the fashion and leather goods division dropped 3% last quarter, slightly worse than expected. The CEO, Bernard Arnault, is warning of a difficult operating environment and says LVMH will limit spending this year as a result. JP Morgan is said to have told its investment bankers to work harder to close the gap with rivals, including Goldman Sachs, on mergers and acquisitions. According to sources, the co-heads of global banking say the group underperformed last year. JP Morgan's investment banking fees fell unexpectedly in the fourth quarter as revenue from M&A advisory declined.
Okay, we're looking at 3 things across these markets today, and I think we have some time to let things breathe, right? So I think the dollar story is interesting because we are getting a bounce from the lows off the cutoff. But as we were pointing out, we've yet to really see the full extent when London opens up as a forex hub, and of course, given the comments coming out of the U.S. president, and that Europe will be waking up with cable at these levels, with the common currency at 120 and dollar yen certainly at October highs, October lows as far as this is concerned. So yeah, it's going to be. I'm curious to see what London does with this information.
And really, this is coming at a time when I think Steve and Jen from Horizon had a really great report about this. That this is still a generation of currency analysts that are accustomed with dealing with strong dollar and strong U.S. economy. It seems like right now we're divorced from that, right? You still see a very resilient U.S. economy, but the dollar continues to weaken. That's something that I think traders are going to have to digest and really kind of deal with this new structural sort of weakness in the dollar that maybe we're not paying that much attention to just yet, according to Steve and Jen. So does that mean that there's plenty of room for a dollar to weaken further from here? Certainly the cleanest trade that we've seen perhaps could be what we've been seeing already in Asia, right? The yen, the renminbi as well, where, we're at 152 levels for dollar yen right now. So,
I guess do what works and do what's cleanest, do what's clean. I think in the equity markets, that's Korea. But you make a good point, right? Some of the models out there perhaps need some updating. How do you model, I think one of the comments coming through, how do you model erratic tariff policy?
Or geopolitics.
As a premium on the dollar when the economy is doing well.
Yes.
In fact, it's doing well enough, you could make the argument the Fed does not need to cut interest rates, right? If you're leaning on the hawkish side of things. But yes, I mean, the other side to that, when I woke up this morning, I had, 1.2% drop in the dollar. Effectively, the U.S. president could be cutting interest rates on behalf of the Fed, right? And what that does to monetary conditions is certainly something to talk about. The fix was also interesting, too, because in the sense that they did not lean against the move in the markets. StoneX has come out with a comment coming through, and that the fix does not signal any directional push coming out of the PBOC, and hence why we're getting not so much reaction right now in dollar China.
Yeah, but that dollar weakness there certainly is helping in terms of the equity space, right? If you take a look at some of these sort of the AI trade that continues here, right? The Kospi continues. You take a look when the market cap of this is now even larger than Germany. Yeah, that is still quite significant. And when you have the largest sort of weights on that benchmark, Samsung and SK Hynix also set to come up with their results on the same day. Seems like there's plenty to look at, too. SK Hynix is up to 5% here. We're talking about the Kosdaq index, 3.5% higher. This is Bloomberg. Welcome back to the China Show. Here's a look at the HSI half hour into the session. And we are talking, well, first of all, let's talk about pollution, right? Dave has been talking about his allergies all week. Oh, my goodness. But you can see through our bump shots here this morning. I don't think that's just fog. But there's not much fog when it comes to the equity space here. We continue to see milestones being hit. The Hang Seng is at 4.5-year highs right now. We're near records on Asian stocks. The Kospi just hit a milestone here. Its market cap is now larger than the likes of Germany, which is the number 3. So certainly there's plenty of fodder, plenty of reasons, I guess, for investors to seek refuge, just given the volatility that we see in the U.S. of late here. And the dollar moves we've seen, when you're talking about a near 3 standard deviation move on the Bloomberg Dollar Index overnight, that certainly is helping and underpinning what's going on in Asia here today.
It really is. In fact, we've broken out of this recent range, right, that I think we touched on that top end yesterday, Hang Seng. We did open above that right now, so 4.5-year high on the Hang Seng Index. Flip the page, please, and have a look at some of the movers here. Despite, of course, the air pollution out there, so we welcome. It's AFF, so a lot of guests are in the city to.
And Goldman.
And Goldman, the macro conference, right? So pardon the weather. Apart from that, everything is going well. It does seem, though, like I was telling Yvonne, my nostrils seem like there's a gymnastics exhibition that's taking place.
Oh, gosh. No one needs to see that.
Somewhere in there. Well, all they need to do is look out the window if they're in Hong Kong today. Who would imagine we'd be talking about PM 2.5 again? Anyway, I digress. Markets are doing well. Hang Seng Financials Index is at the highest, I think, on record. There's some news around some of the healthcare names in China. The State Council issued some revised regulations around the implementation of the drug admin law. They are encouraging R&D and innovative drugs. They're tightening supervision, though, as far as online drug sale platforms are concerned. Back to the big market macro story, though, is the drop in the dollar. 2-day look, that big drop overnight into this morning, where we are getting somewhat of a bounce on the Bloomberg Dollar Index coming through. The iteration on the Asian FX space is dollar Korea, dollar Taiwan, ringgit, and the Sing dollar, which, by the way, so tomorrow's going to be busy because we get earnings coming through out of the big Korean names alongside an MAS decision coming through as well in Singapore. So just keep that in mind. Precious metals, spot gold hitting a fresh record about an hour ago, 50 minutes back, in fact, to be more specific. Silver's coming up, platinum and palladium. And just very quickly, Indonesia is coming
down 7%, Dave.
All right, what's going on there? Okay, let me have a look at what's happening in Indonesia. Okay, so Jakarta's coming online. We're about 2 minutes into the stock market set. Okay, here we go.
Oh, MSCI.
Yeah. They're freezing new index changes on that. Okay, intuitively, that doesn't make... I was about to say it doesn't make a lot of sense. It probably does. There's not a lot of detail, though, as far as that headline is concerned. Clearly, not a lot of detail is needed when the market's falling by this much. 7% to the downside right now.
So a little bit of information from our markets producer, Anthony Stevens. So basically, MSCI has said that the shareholding structures are too opaque to keep MSCI Indonesia weight. So they have frozen it in place for now. That is the latest, but that's enough, as you say, for traders and investors to kind of hit the sell button here this morning. We're down 6.5%. That must be a big move that we haven't seen for some time.
Yeah, it's the biggest since Liberation Day of last year, right? So it is quite tangible. I think we've taken out the trend line to the upside too. So I would imagine this is something that we will endeavor to get more details on in the next hour or so. In the meantime, though, let's take it back to the broad market story. And we did hear, of course, from President Trump talking about literally the yo-yo effect on the dollar and other reaction from some of our guests on these big FX moves.
No, I think it's great. I mean, the value of the dollar. Look at the business we're doing. No, I want it to be just seek its own level, which is the fair thing to do. You could have it. I could have it go up or go down like a yo-yo.
I think there's a little bit of a reposition here. You'll notice stocks in the U.S. are not down. So people are sticking with their risk positions, but I think are probably buying some tail risk protection, hedging the dollar. I think we saw that in the first half of 2025 also. I think it will run its course. It puts an onus on calming down some of the tail risk, and I think that would help this.
We certainly want to hear from Secretary of Treasury Scott Bessent about the role that his department has in terms of dollar policy. Has anything major changed from his point of view? Does he want to encourage this sort of price action? It was a very sensitive time of day, I'd have to point out, in the 24-hour cycle for FX. It was a very illiquid time. I definitely agree with the knee-jerk response on the dollar, but whether it is a major change, it's still a little bit early to say.
Stephen Englander is with us, Stan Charts, global head of G10 FX Research, to talk us through these massive moves in the dollar and perhaps what is in store short and longer term. Stephen, good morning from the Asia Pacific. Thank you for joining us. What do you think is going on, sir?
Well, I think that there are a number of short-term reasons to sell the dollar. And, we've been dollar bulls, but our bullish case is long-term, driven by productivity growth, higher real interest rates. And that case isn't showing up nearly strong enough to offset the selling that's coming on. I think it first started with, some concern about the, Greenland and sort of what the U.S. was willing to do in terms of foreign policy. I think Japan and the issues with the yen and the JGB market exacerbated this. And I think one factor is very important, which is given that we've been in a very low volatility period for the last 4 to 6 months, I think short-term investors in FX took a signal from how easy it was, how little opposition there was to the dollar weakening. And that just encouraged them to pile in. And they continued to do that when they saw that there was no real pushback. So I think, the question always, abstractly, I can't tell you what the difference is between 115 and 120. So what stops it from going even higher? You have to see something break, either some indication of U.S. policy, some indication that Europe is suffering or that other countries are suffering economically from the lost competitiveness. But if there's no real pushback, it can go further. Ultimately, as President Trump says, there is a level. But in the FX world, you never know with any precision what that exact level is.
So how do I gauge what is going to be driving FX and dollar before? It doesn't seem like, rate differentials is one thing. Is it still, a time to really be putting a significant sort of political risk premium on the dollar, just given the uncertainty that we've seen around Trump policy?
Well, I'll give you the example of Liberation Day. Our equations are telling us that there's about a 6% risk premium on the dollar right now. And the peak around Liberation Day was 6 to 7%. And it took 6 months of policy stabilization for that to erode. By the time we got into Q4, that risk premium had gone down, but it came down very slowly. So I think that it's sort of a message here that it's, if the shock is big enough, you're going to see vols pick up, you're going to see concerns pick up. And I'll tell you, our equations are saying this is completely risk premium. There's no, policy story or rate differential story or, behind it. If U.S. policy stabilizes, if Besant comes in and kind of backs off from looking as if they supported the dollar weakening, I think gradually we will see it. And ultimately, think back to 1995 to 2000. 1995 was a real low. Everybody was selling dollars. And by the time you got to 2000, everybody was buying it back again because the underlying economic productivity, growth, profits picture was so compelling.
Stephen, maybe just to take the devil's advocate, I'm curious what you really think about this. So I think it was 2 weeks ago, Scott Bessent's comments that that strengthened the Korean won. We had obviously comments around Japan that strengthened the yen. We had this morning's comments coming through from the president not standing in the way of a weaker U.S. currency. It doesn't take a massive stretch of the imagination to put those three things together and say, and maybe conclude, there does seem to be some weak dollar policy. That's a question mark for me. What do you think? Is there a implicit weak dollar policy here?
I'll start with President Trump's comments. I think that they were opportunistic, in the sense that he's argued for a weak dollar, and if the market's giving it to him, he wasn't going to stand in the way. I think the yen and won comments, we had gone through a period where yen and won weakness were domestic political issues domestically there. So I don't think he was meaning to pitch in and weaken the dollar overall. I think he was helping out his colleagues in Asia.
his buddies. Okay.
Yeah, tell me about the yen. I mean, are they done, you think? I mean, it seems like just the talk of maybe, rate checks from the New York Fed, which is quite rare, and the BOJ was enough to stabilize things. We're at 152 levels right now. Or do we need to really see some follow-through on intervention for this trade to continue?
Well, I'm actually not sure it's an intervention story. I mean, if you look at the way the yen and JGB yields moved, with yields going up, the yen weakening, that's not a carry trade. That's the opposite of it. It's a lost credibility trade. So I think that there's some fundamental issues that have to be dealt with in Japan, and some concerns that are emerging on the long-term fiscal sustainability. So I think that, they can intervene and it's going to have an effect. But if the budget and the stimulus are still there, and it doesn't look like there's going to be a way of reining it in, I think markets will still be concerned.
Can I ask you about, and sorry to circle back on Donald Trump, because you mentioned something during the break, and I think it would be fairly valuable for our viewers. People talk about the taco trade. Tell us about TUGS, T-U-G-S, if I'm not mistaken.
Yeah, exactly. I think the more accurate characterization is Trump usually gets something. TACO implies that he pulls back the whole way, but as we saw with the Liberation Day tariffs, he asked for a lot, he got something. In most cases, he gets something from his demands. And I think that that's the more accurate gauge by which you should measure his effectiveness. You might decide that he didn't get anything, but I think the idea that if you announce a 500% tariff and you move from that 500% tariff to a 50% tariff, you've chickened out, I think is ludicrous, because I think the point is to get something and to apply pressure on the margin, not the most extravagant or outrageous comment that you've made. So the point is, see what he gets, not what he says.
Yeah. How do you factor that into models, and how do you express that at TUGS in your coverage?
That's very hard. But as a good example, everybody was petrified after Liberation Day, thinking that we're on the breach of a trade war, that, destroy global trade, the world economy was going to fall apart. When the administration saw that it wasn't working out the way they wanted, they gradually became friendlier. The tariffs went down, the negotiation pace went up, they cut deals, and they got some tariffs. It's not clear how much foreigners are paying or whether it's the U.S. person, but they managed to get something, and their tone changed a lot in the course of that period. When they decide that it's not working their way, they back up and they they try and cut the best deal that they can. And I would say that the midterms are coming up. Nobody's going to vote for Trump because of tariffs. Nobody's going to vote for Trump because of Greenland. And all this is a distraction. What they need is to get the economy going, let the productivity juices work. There's some fiscal stimulus from tax refunds. See if they can get mortgage yields down. I think that would be the far more effective course. And I see enough rationality, at Treasury and a few other places in the administration. I think that that's the direction they're going to push in coming months.
And if all those stars align, I mean, you might just get, Stephen, your stronger dollar call, right? The longer term, and if the U.S. economy does strengthen that way. Just a final question: we almost did talk about the Fed. I can't believe we're this close and we haven't talked about that. So, do you think Donald Trump gets something along the lines of what he's been pushing for the Fed to do? And he also mentioned a few hours ago he's close to naming his Fed pick. Who do you think would be the most dovish for the president to get something out of that?
Well, I've taken myself off the list, so don't worry about that. Okay, look, what we've written is that we think that Reader is the best compromise between the three things that he wants. He wants loyalty, he wants somebody who has the respect of markets, and he wants somebody who's friendly, who believes that the supply side juices are there. With respect to some of the others, I think that there are issues. And if he really wanted a Warsh or has it. I mean, he's known them for so long. It's unclear why he hasn't just named them already. And I think Warsh would actually be a step, forward in terms of reducing risk premium. He has a very strong reputation in markets. And I think he's viewed as being independent, even though he's sympathetic to, they say more reader. He has a lot of respect in markets. He's viewed as being independent, even if he's sympathetic with the broad thrust of administration policies.
Stephen, it's great to have you. Thanks for coming on. Stephen Englander, their Standard Chartered Bank's global head of G10 FX research, joining us live in Mexico City. Still ahead on the China show, we got Goldman's outlook for Chinese metals demand as prices continue to soar. More from the Global Macro Conference a little bit later on. This is Bloomberg.
It's time now for a quick look at some top headlines in Chinese domestic media. UK Prime Minister Kier Starmer is getting some positive coverage that's ahead of his arrival in Beijing. Later today, the nationalist tabloid Global Times is framing his visit as a pragmatic approach, with experts saying London increasingly recognizes China's growing weight in the global economy.
Meanwhile, the paper's editorial today says that improving China-UK relations creates more opportunities for advancing a multipolar world. And it says a Starmer stance of not taking sides between the U.S. and China reflects the West's rethinking of, quote, outdated concepts of security, civilization, and international relations.
And the key goal there for this trip specifically seems to be broadening the trade ties with China without annoying President Trump. Our China economy and government reporter Colin Murphy is with us out of Beijing to help us understand the context and a preview really of this upcoming trip in a couple of hours. Colin, so what is he trying? What do you think he might get out of this trip, and what do you think he will try to get out of this trip?
I think, obviously, as you mentioned, the challenge is to balance the economic issues with concerns over national security back home, but also with the optics in terms of whether any trade deal might sort of upset the US and Donald Trump in particular. So the focus on trade, especially in services, is a very important area for the UK. And I think, obviously, the Chinese are, as we've seen from the coverage this morning, they're ecstatic about having Starmer here. It's another sort of prominent global leader arriving in Beijing at a time when a lot of US allies are trying to explore other options, especially when it comes to trade. So he will be trying to walk this tightrope between, the focus on economic and trade and sort of compartmentalizing areas such as that touch on national security, try to sort of downplay those risks, and basically herald a new stage for UK-China relations. So he has a couple of things to do in parallel. So it'll be interesting to see how he manages to navigate all of these different factors.
Yeah, whether we see that sort of return to the golden age, right? I think he mentioned that back in December about, that brings us back to when, Cameron shared a pint with Xi at the time.
Yes.
But, is he worried it will upset Donald Trump, if any at all? I mean, how are they going to navigate these sort of tensions?
Well, in an interview with our colleagues in London earlier this week, he was very adamant that this was not going to be an issue, that the UK doesn't have to make a choice. And he dismissed any concerns that it would upset Trump. But of course, he's going to say that, right? I mean, what else can he say? The issue here is what Trump sees. And we have a case study as recently as last week when Mark Carney from Canada, the PM there, came to China and struck what was, on the whole, quite a modest deal. But even that was sufficient to, annoy Trump, and now he's threatening tariffs on Canada. I don't think the UK and Canada are necessarily apple to apple here in this case. Obviously, Canada is a geographical neighbour of the US, so the calculations might be a little bit different. But still, the UK and the US ties are very, very strong. And It's not as if Trump is completely without criticism of Starmer. I mean, most recently he was unhappy with the British Prime Minister's moves to return an island in the Indian Ocean to Mauritius. So let's see. It will be key to see will be the scope of the actual deal. So, for example, even though the UK may really want to have, say, Chinese investment in the EV industry or in the battery industry, maybe that's something that right now would not be sort of good signaling to Trump. So maybe we'll see some sort of caution in terms of the nature and the scope of the deals that are struck between the UK and China this time around.
Cullum, thank you. Cullum Murphy there. We look forward to, of course, your reporting on this trip here, which, as you say, plenty of implications to come. In terms of when it comes to markets, certainly we'll be focusing not just on the geopolitics, but really what the FX side of things is. But in terms of equities, we're still looking pretty good when it comes to the Hang Seng. We're still holding around those 4.5-year highs for HSI there. CSI 300, you're seeing some of these big sort of, local chip names like Giga Device that's really kind of leading the charge here this morning. Nikkei is going the opposite direction, and Kospi continues to fire on most of all cylinders there. This is Bloomberg.
Right, welcome back. You're watching the China Show. We're going into the Japanese lunch break. The market's in focus because it's going against the grain today, as you can see. So despite the up arrow, amid the up arrow story, it's really the strength in the currency that's really playing out there. Transport equipment, so a lot of the companies effectively that have a massive portion of their revenues and business outside obviously will get hit. The negative correlation between the equity markets and the value of the currency. Separately, though, we're also looking, and we'll talk about a bond auction later on, by the way. So there's one coming up later today. SoftBank, okay, so some reporting today that it is in talks for $30 billion more in terms of their investment in OpenAI. Stock is up 3.5%. That's really leading to just also broadly this rally across not just SoftBank, but also across the chip space. Memory, for example, we'll talk about that later. Other names to watch, we talked about this, Toyota. Shinetsu Chem, I think this is an earnings story. Really, this is the single biggest points drag on the benchmark today. The others we talked about there. That's an earnings story. But yes, we will look at how Asian markets are faring as we go to break. We'll leave you with that. Plenty more ahead. This is Bloomberg.
All right, 11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a moment. And we talked about sort of the weakness that we're seeing when it comes to stocks here, really kind of bucking the trend for the rest of the region. Dollar yen, though, we're still continuing to hold on to strength, although we come off a little bit, but we're still talking about 152 levels for that. Euro yen is also at 183. We flip the boards and look at long JGBs because we are on guard now for the risk of another meltdown, potentially. If we see some bad demand when it comes to, of course, that 40-year bond auction. This is a tender, of course, that has proved vulnerable to sharp swings. So certainly that's one to watch in the next hour, Dave.
$399.6 billion being sold today. So we'll see what demand looks like for that. That's about $2.6 billion. But yeah, okay, commodity markets, we're looking at that too. So I'll look at base metals for you. I think the upgrade this morning coming through from Goldman Sachs on aluminum specifically, aluminium, of course, depending on your side of the Atlantic. And we're looking at base metals too, but the story certainly has really been in precious metals, which we've talked at length about. But yes, we will take this as a jumping off point to head straight back to the Goldman Sachs Global Macro Conference in Hong Kong here. And Stephen Engel is standing by with a very relevant guest to the topic. Steve.
Yeah, we're going to again test our mettle here, of course, Dave. And we're going to talk to Trina Chen, Goldman Sachs co-head of China Equity Research, also the analyst in China Basic Materials and Agriculture. Thanks so much for joining us.
Thank you for having me.
So you're telling me you're constantly being peppered with questions from high-frequency traders about the market right now in certain metals. We've seen a run-up in prices. We saw the aluminum. We've seen copper. No doubt gold, for sure. What's the main question and what's your answer to those questions that they're trying to... They're not looking at a one-year horizon. They're looking at now.
I think it's a combination of both. And obviously, the high frequency data, impact everything, we think, next day. So that's, sometimes it runs into a different direction than what you thought in terms of your positive view in the long term. I think everyone is probably right in terms of where price is now, which is, structurally higher than the past many years. And there's a reason behind it, mostly related to supply.
Yep.
But we are where we are. And I think this is the point where we are here because there's a fundamental support and there's also fund flow and a macro backdrop.
Okay.
And then I think the importance is we sort of are coming to a point after the rapid surge of pricing that these two no longer support each other. Okay. So we're seeing the macro support continue to be very resilient, fund flow, investor interest. On the other hand, the real the producers on the ground, they start to respond negatively recently in our monthly survey, order book survey, that we're seeing some pullback in demand. So, for example, order book in copper fabricators has declined 10 to 30%. You're talking about delay of orders, the fragmentation of order books from consumer electronics, hardware. So this is pretty typical. Even grid orders, we're seeing some slowdown.
Okay.
I do think we have a technical adjustment in the near term, given the departing of these two drivers and the rising inventory, and that's something probably in a good time we have to think about it.
But at the same time, so for example, and for the producers, we can bring up aluminum. Aluminum prices have been above $3,000. You expect it into this first quarter to stay above $3,000, but not for the full year. Oversupply is going to be the problem, and there's not going to be more supply coming online.
Correct. I think that the fundamental beyond this next 2 months is absolutely, you're correct, is very different. If you look at the copper supply growth this year is very limited. We're at the mercy of all the recovery of the tier one asset that has been disrupted last year, which is going to be very slow. But in aluminum, currently the return is just too attractive.
Yeah.
You're basically looking at a margin of 8,000, 9,000 RMB per ton, where your investment is almost just 15,000. So we're actually seeing expansions. I think this is going to be the year, probably surprise to many people, that both China and ex-China output growth will be higher than people's expectation. And over the past 5 years, this will be the year with the biggest delta in terms of the output growth.
How does the anti-involution or the anti-involution campaigns to essentially try and stop price wars and prices racing to the bottom, how is that going to essentially buoy certain areas?
Yeah, I think that's a really good point to bring it in. You look at a commodity market, you almost see two very divided camps. So there's one camp where it's industrial metals, where everyone's interested. Certainly you have a good supply-demand picture. And the problem we have is a good problem, price may be too high. But on the other side, you still have all these bulk commodities, for example, steel, cement, coal, and these are traditional sectors. The demand is not growing, even declining, still oversupply, probably deteriorating every year. And that's the part where anti-involution goes in. My understanding of that is the policy effort is not about generating a sector with super profit, but it's really about protecting the tail and the risk of those sectors in case things get worse.
Right.
So capacity exit work needs to be done. We are seeing a lot of progress in cement. We're seeing very slow progress in steel, but it is an ongoing policy effort.
Now, you talked about the risks. You also mentioned in some of your research that the risks from the property sector, which is a big, obviously creator of demand for these metals, mostly like copper, and also you mentioned cement, but also the risk from tariffs has subsided significantly.
Yeah.
How so? Where?
Yes, I think if you look at the current demand constitute, it's a lot more diversified versus where it has been in China in terms of Chinese commodity demand, whether it's metals or all these bulk commodities. Take example, in the peak day, steel demand 65%, 2/3 actually are construction, and a lot of them is related to property. So today, property sector is only a quarter of size of that. So you still have a lot of issues with property sector, but it's no longer being a game changer, like swing the demand one way or the other. In the meantime, you are seeing very diversified kind of a demand from different areas. Some of them actually relative new growth, and therefore the range of uncertainties become very little. Tariff, I think last year we've done a lot of work in the panic in April and May, and trying to understand what happens in the downstream. But it was very surprising, even in an extreme period of time, you did not find a detrimental impact of Chinese production on an aggregate basis. But now certainly that risk today, for now, is not on top of the mind.
Well, we're all scrambling as well to figure out what the ceiling is, or if there is a ceiling on gold. I know the house view is maybe 54, 5,400, or as we possibly test a new ceiling of 6,000 or a new target. Where are your views coming on that?
Yeah, I think there's an anchor part of the driver for gold price, and that is central bank buying.
Yep.
And what we do in our research is we monitor Chinese central bank gold holdings, whether it's the reported number from what's the Gold Council, that's official reporting, or there is actually unreported OTC numbers. We could actually add it on.
But PBOC was adding last year. Are they expected to continue to add?
I cannot say it on behalf of PBOC, but the reality is the central bank holding in China is only now half of the US in terms of tonnage. So for the same economy, you could argue there's still room, but will they add at the same aggressive pace, which is almost 800, 1,000 ton a year in a 3,000 ton market? That has a very big price impact. We're not sure. But as long as there's adding, there's a support to gold price. But beyond that, where the recent surge, I think that's making everybody a little bit uncomfortable.
Right.
But there's a reason certainly behind it. But those uncertainties comes and goes.
Right.
So for us, we focus on central bank purchase.
Fantastic. Trina Chen, thanks so much for your time and having us here at the Goldman Macro
Great
Conference.
to speak with you,
All right,
Steve.
Thanks a lot. All right, Dave, sending it back to you. Another big interview coming up in the next hour. Don't want to miss it.
Yep, absolutely, yeah. I've set the alarm, of course, coming up there with Steve Dan Wang, of course, at the Global Macro Conference, Goldman Sachs there. Okay, just briefly, the emerging market story in the last hour, this open of Indonesia, and stocks are just getting absolutely tossed out the window. This is the biggest single-day drop on the index since Liberation Day, and extremely heavy volumes coming through. And fears because of conversations on what possibly could be the implications of this MSCI move. The headline is it would pause certain index changes until regulators address the concerns over these tightly held large cap stocks in the country. And I think we've stolen the thunder from our Asian equities reporter, but there's enough here to explain to us. Abhishek Vishnoy is with us out of Singapore. So, before we talk about implications, what exactly are the concerns of MSCI here, specifically, Abhishek?
So MSCI has actually, in simpler terms, just put on hold any kind of changes, or rather any kind of positive changes that can happen to, Indonesia's benchmark. And this is possibly a structural test of Indonesia's market structure, how regulators handle it. We had already seen some outflows happening last week ahead of this consultation, which was getting completed by the end of this month. And given the market's reaction today, it's pretty much a given that there might be a lot more outflows. Now, David, we have to look at it in this context that MSCI has raised some investability concerns pertaining to their rules, and that is largely in direction of how free float is being calculated in Indonesia by the local regulators. Given their concerns, just like how cash is valued at a discount in market, there are voices emerging. Market participants are saying that the current free float that Indonesia commands, which leads to about 1.1% weighting in the MSCI EM index for the nation, needs to be looked with a lens where it can be reduced by 30 or 40 odd percent. Now, what that means is if you are an active fund manager and heavily overweight on Indonesia, suddenly you are double the overweight of what you were earlier. And in this context, we are seeing a lot of selling in the market. There is no change in the index. So this is not a selling which is driven by passive funds yet. This looks like a selling which is driven by active funds. This is a structural test for the market. The regulators have told Bloomberg reporters that they continue to work with MSCI to manage their concerns, to work towards an area where they can come together in terms of what an actual free float would look like. But whatever is the outcome of this, it looks like Indonesia would either command lower weighting, as MSCI said, or there is a risk that it may get even demoted to a frontier market status, which will mean further outflow from emerging market funds which have been holding Indonesia, and some of them are holding Indonesia in excess of 7 to 8 odd percent, which is like 6 times the weighting that it commands in the index.
Okay, so there's a threat of a possible reducing the weighting and also even just downgrading to frontier market status. What do they need to do? I think they have until May, right? Is that sort of the deadline for them to actually, spark some sort of reform now?
Yeah, so, it's basically MSCI putting the ball in local regulators' court. They're asking OJK, IDS, and, the local depository to come out with a free float definition which is, clear, transparent, and fully disclosed and aligns with MSCI's methodology. Now, if you look at MSCI's consultation paper, which was focused on this matter, the MSCI methodology essentially meant that almost every stock is likely to command a lower free float. Thereby, by design, Indonesia is set to command a lower weighting in the MSCI Emerging Market Index. They can continue to work till May, but that essentially sets the pathway for active funds to pair their weighting and recalculate, how they are looking at Indonesia. Look, this is not just, while this is about free float, this is not just limited to free float. It raises governance concerns. It gets married to the macro and policy concerns that have been raised via the economic growth outlook or Danantara. And all in all, this essentially means lower valuation multiples as well. So while earnings may not get tested right now, valuations for sure are getting tested.
Yeah, as you mentioned, investor confidence leading up to this decision was already quite fragile given proposed policies and the like, and Idrawati is no longer in the government. You had the latest when it comes to proposed nephew now joining the central bank as well. So plenty of issues, it seems. Abhi, thank you. Abhishek Vishnoi there, senior Asia equities reporter, joining us out of Singapore on Indonesia. We're still seeing the JCI down some 5% this morning. Coming up, India and the EU seal a free trade deal after almost 20 years of negotiations. We'll look at the winners and losers on both sides next. This is Bloomberg.
We delivered the mother of all deals. We're creating a market of 2 billion people. And this is the tale of two giants. And by combining these strengths, we reduce strategic dependencies at a time when trade is increasingly weaponized.
Friends,
India has completed its biggest and most historic free trade agreement. This historic agreement will make it easier for our farmers and small businesses to reach the European markets.
That was the European Commission President Ursula von der Leyen and Prime Minister Narendra Modi on the EU's trade deal with India, and sealing, as we just mentioned, after, nearly 2 decades of negotiations. Indian Prime Minister Narendra Modi is hailing the agreement as good for his country's manufacturing and services sectors. Let's bring in our chief Asia correspondent, Rosalind Matheson, on more. Von der Leyen said this is the mother of trade deals, Roz. What were some of the details of this deal?
Well, obviously, as you're saying, it's a massive trade deal for both the EU and India, negotiated for many, many years, but perhaps given a bit of an extra push of late by what we're seeing as the fragmentation of trade and relationships around the world and the desire to diversify away potentially from the US market. But as you say, it encompasses quite a bit. It really opens up these markets to each other, although a little bit of extra protection still for India in terms of agriculture and dairy, but allowing a lot of access to India for European car companies, which is a very big deal, particularly for Germany, a massive producer of autos in Europe. And on the flip side, a lot of India companies will now get access to the European market, particularly around apparel, footwear, textiles, also food companies, for example. So a lot of sectors there that are going to benefit potentially for India. But also part of this trade deal is also a security agreement that was reached between the two, which is about, again, sending a political message that they're drawing closer in general. And these are understandings around things like sharing intelligence and perhaps joint development of weapons and so on, which is also particularly potentially good for India companies as well. So there's a lot of moving parts in this agreement. It'll take a while to take force and to be enacted, but it's a pretty strong signal of where they see the world going right now.
And Roz, if you could talk maybe about one or two winners and losers as the market tries to figure out maybe who gets ahead here and who doesn't.
Well, certainly it may not be the best news for India car companies, because you are going to get European automakers having greater access now to the Indian market. So that's one sector that might lose. Also for India, perhaps liquor makers, because you can have these big European liquor producers having greater access again to the Indian market. But on the India side, as I was saying, like companies that produce textiles, footwear, apparel in general, and also India food producers might benefit. So there's winners and losers on both sides, but the sense that overall it's going to benefit the economies of the EU and India over time, with a little bit of protection, as I was saying, for the agriculture and dairy sectors in India, because those are very politically important as well to Narendra Modi, the Prime Minister, so he didn't quite want to open them up completely. So there is some protections there.
All right. We will see how the market open is in India and how that fares. Rosalind Matheson, there, our chief Asia correspondent, on, of course, that EU-India trade deal. With much more from India later, live from India Energy Week taking place in Goa. The World Nuclear Association Director General joins today's edition of Insight with Haslinda Aman, along with the chairman of Kawasaki Heavy Industries. This is Bloomberg.
Okay, right. The data actually just came out about an hour or so back. So Korea has now officially, when I sense that the data at Bloomberg has now topped Germany in terms of a market cap. Nightmares of that World Cup. I think it was 2 World Cups ago when Korea actually beat Germany. And quite a nightmarish ending, of course, for the Germans. And this time, of course, it's really down to the tech space. So you've been watching the wrong K-pop if you've been focused in too much on the Blackpink concert here in the weekend. This is the K-pop that's going to make you money.
Ooh. I still rather watch Blackpink. But yes,
it was pretty nice what Rose did, actually, when she came out with like local Hong Kong treats, right?
She does that in every city. She tests the local delights and she eats them while she's like heading to her next spot.
Right. It was a bubble tea.
Yeah.
It was
milk tea.
Oh, it was milk tea. I'm sorry.
And the waffles, right?
And the I don't know what you call it. There we go.
Yeah.
Yeah.
Yes.
Ooh,
speaking of K-pop, right? If you take a look at some of what we're seeing, it's really the memory makers that are really massively higher here this morning, right? And you take a look at what SK Hynix is doing, even just regionally, right? Like Giga Device, that's really kind of what's propelling the A-share market today with 8% gains on that stock. Or this is the H shares, I should say. But, you know, on Thursday it's going to be interesting when you have Samsung and SK Hynix both reporting at the same time. We're already writing about these dual earnings calls that are going to be happening. So the market's going to be really on tenterhooks about the outlook for memory chips. Obviously, that's going to be the key thing. But really, there's kind of rivalry, you could say, between the two when it comes to HBM, right? Now that we have Samsung in this partnership with NVIDIA, are they now ready to actually close that gap with SK?
It's done well if you were just sitting on an index, right?
Yeah.
Because both have really, really done well as far as that's concerned. And really, what really kicked, if I remember correctly, in the last few months when I think Samsung raised their game, well, it was an interview with one of the executives and they talked about the price hikes around that space. It really kicked things up. Anyway, we'll get more guidance from that tomorrow. Very quickly, cable stocks jumping on the back of this deal with Meta, coming through on your screens. Also, this downgrade coming through. And speaking of, that's why I had my head was around bubble tea. Mishue, actually, which is a listing here in Hong Kong. We are looking at a downgrade coming through out of UBS. Yeah, the bubble has popped as far as this specific one. I remember this listing too. Which is quite interesting about last year, of course. We're looking at the Hang Seng Index. So we have taken out the highs of last year and now puts us at about a 4.5-year high as things stand on the Hang Seng benchmark here. Just very quickly, long end JGBs on your screens. The 40-year auctions coming through. Bid to copper. We'll see what that looks like. That is it from us here on The China Show. Plenty more ahead here on Bloomberg Television.